All right, welcome back to Fast Forward. Stocks are falling on the weak jobs numbers. Our next guest has been bearish on the U.S. recovery for, frankly, quite a while. He's Peter Yastrow, principal at Yastrow Origer. He joins us from the CME Group with reaction to today's report. Now, Peter, you, I believe, are a master. You have a master's in statistics. There were plenty of statistics out this morning, and they didn't look too good. So talk to us about them.
Well, the jobs report across all fronts looks bad. There's really not a lot of positive in there. And I think it's important for all of us to just take a step back and say, you know, I don't need a statistics degree from University of Chicago to understand the U.S. economy. The U.S. economy did great for a long time because of the real estate boom and the build out from all of the housing. The banks were financing it. The banks got burned, and now the banks don't want to finance it anymore, and we're seeing an implosion. Going back through 2000, 40% of the job creation in this country was either mortgage-backed finance, building construction, or home remodeling. That's 40% of the jobs created since 2000. You just destroyed that industry because the banks have gotten smart. So now it's like watching a train wreck in slow motion. I mean, we are just watching every month. The numbers keep coming in. And for the president and for Congress to be so oblivious to where the problems lie and to talk about trying to fix it with tax cuts and incentives is like putting a Band-Aid onto a gunshot wound. I mean, it's just not the right medicine for what is a major, major problem with our economy at this point.
From your point of view and from the point of view of the other traders around you in the pits, what would be the right solution?
Well, you got to think a lot bigger. Either we're going to have to all realize that we're not able to make so much money in this country that we can live so much better than all the other people we trade with. And that's a pretty painful realization for most Americans. Or we're going to have to figure out a way to make ourselves actually be able to earn more than anybody else. And it just comes right back to good old-fashioned, you know, who's worth it? And, you know, if a worker in Detroit is not able to produce twice as much as a worker in Osaka, then you can't pay the worker in Detroit twice as much as the worker in Osaka. And as the world is becoming smaller and smaller, these labor disparities are becoming more and more obvious. No one wants to hire Americans. They tend to be overpaid. They get tremendous amounts of benefits. They get maternity leave, whether you're a man or a woman, all kinds of things that they just don't offer in other countries. And it really is not sensible to hire in America. You just make an economic decision, and if you're acting rationally on the best behalf of your shareholders, you would never hire Americans. And I don't understand why people are scratching their heads over that point. Ask any CEO that needs to beef up how he's going to do it, and he's going to say, I'm going to avoid hiring at all costs. It's not that complicated, I don't think.
All right, let me ask you, that paints a pretty bleak picture. So what is the trade from your point of view, given that perspective, and perhaps also ahead of Obama's speech next Thursday?
Well, let's assume that the Fed is going to continue to keep interest rates as low as they possibly can. And let's assume that the economy is going to stay mired in this mediocre growth as Washington stumbles around and plays politics rather than getting the solutions. So you're going to have a long period of cheap money flowing into the economy. The companies that are able to take advantage of that are the large multinational companies that do a lot with money but don't do a lot with people. You know, the GE Capital model comes to mind right away. You look at a company like that that uses huge amounts of capital and has production all around the world. Those are the kind of companies that you buy, you hold their dividends. Procter & Gamble pays over 3% dividends. They're going to still be selling their products. That's a very steady company. So my advice is to take advantage of these dividend yields and just buy those, because at this point you're not going to make a fortune selling stocks short. That's just a mistake, because these companies are still making earnings. They're still profitable. I tell people all the time, you know, my basketball team might get killed by your basketball team, but I'm going to score a few points. So don't assume stocks are going to zero here, because I don't think they are.
All right, Peter Yastrow, thanks for joining us. Admittedly, not a bright and shiny commentary, but that's reality.